Hello, I'm Bernard Hickey from interest.co.nz and welcome to our investing report. Today we look at the results from the first receivers report out for Lombard Finance. Now for those people who remember Lombard Finance, it was the one with the ads on TV and in the paper which advertised its Grecian or Roman columns, and it also sponsored the Sunday Theatre on TVNZ. It was hoping that you'd see it just as a bank, and the suggestion was it was as safe as houses or something very solid. It also argued that it was making loans on residential property, but it turns out the loans were to residential property developers, and most of the loans were second or third mortgages. Also, most were interest paid on maturity loans. That means you had to wait until the development was finished and sold off before you got your money back. And the biggest loan was to a development in Wellington, the Brooklyn Rise development, as you can see here. Now this was built by Tim Manning, who's been accused of building leaky building projects in Auckland as well. More Lombard money though needs to be spent on Brooklyn Rise before it can complete the development. It's only partially done. Now the PricewaterhouseCoopers receivers, John Waller and John Fisk, who've produced this first receivers report, reckon these loans overall are so bad and the market is so tough at the moment, particularly to sell apartments, that investors who've put $111 million into Lombard Finance will only get back between 21 and 44 cents in the dollar, and that's if they're lucky. Also, PricewaterhouseCoopers say they've not retained the services of the executive director Michael Reeves, as you can see here. Now, he was the guy who blamed a systematic failure in the finance market for Lombard's woes, when actually it turns out it was just very poor lending on dodgy projects to dodgy property developers. It also relied completely on debentures. Now what are the lessons from this story? It's the 17th finance company failure. Things to look for when you're investing in a finance company. Firstly, how many of the loans being made are interest on repayment loans? How many of them are to residential property developments, bare plots of land, so to speak? What projects are still to be completed before the finance company gets their money back? And how diversified is their funding? Are they completely reliant on debentures? If that's the case, they might struggle in this market. I'm Bernard Hickey. That was the investing report for interest.co.nz.